Hi, so today we're going to take a look at Dropbox and we're going to see whether it's an undervalued company and hopefully a good investment. Now, I am a paying customer of Dropbox, so I feel like I'm in a good position to understand from the consumer side how Dropbox works and get a feel for the company from a consumer point of view. So if you're a user of Dropbox, well, this is going to be far easier for you to understand. Now, if you are unfamiliar with Dropbox, well, they're one of the biggest cloud storage providers out there. Cloud storage gives people and businesses the opportunity to store their files online remotely, rather than having to pay for expensive hard drives themselves and store them somewhere. Now, the cool feature with Dropbox is you can send a link to somebody and they can open and get access to the documents that you're working on. And what Dropbox does, well, they manage all this data in big storage centers and they also make sure it's going to be secure. Okay, now we're all caught up. I think you understand a little bit how Dropbox works. That's probably enough to do the analysis. Oh, and hit that like button for me so I know that at least a few people got something out of this video. Now, if this is the first time you've seen one of my videos, well, welcome to my channel, and my videos are about investments that anyone in the world can make. Now, Dropbox is actually a little different to the companies I normally look at here on the channel because they've actually recently done what's called an IPO. And that means that their shares are actually been only available to the public for a short period of time. Well, March 2018 to be exact. Now, normally I completely ignore startup companies and recently IPO'd companies because they don't have any track record. But Dropbox has actually been around since 2007, and I personally have been using them for about a decade now. So I think in this rare case, we can go back and get enough data to make an informed decision. All right, so here's what I see are the positives for Dropbox. Now, they firstly have a recurring revenue business model, which I really like. It makes things simple for businesses to pay them. And it's great for Dropbox as well to have a predictable revenue stream. Now, in my opinion, well, Dropbox is very user-friendly. I personally think it is great, and I love how it syncs really nicely with my Apple laptop. Now, I know this is subjective, and we're going to get into some data later, but I think the subjective side is important to note because I'm familiar with this product and I just like how it works. I just haven't had any issues with them. And also I know it works seamlessly with Slack, Microsoft Office, Zoom, and Google Drive as well. Now, there's also high switching costs for their business customers. Now, not in money, but in time and effort. There is also no real reason for their business customers to change. The product works well, and the effort to change and learn a new system seems way too hard and not a priority. And so far, their business customers have proven to be very sticky. Now, moving on to some of the data that I think is positive, well, they have 600 million users right now, and only 15 million of them are paying customers. So there is a lot of expansion out there for them. If they can increase this percentage even just a little bit, it will mean a lot to their revenue. Now, with the positives out of the way, I think it's very important to look at the threats, and competition, I think, is their biggest threat. Microsoft OneDrive and Google Drive are very big time competitors. Now, where I see a difference with Dropbox is that they're trying to make a more user-friendly service that works with everything else. See, where Microsoft and Google, they're just trying to keep everything inside their own ecosystem and not work with other people. Now, in their financials, I'm going to want to see whether Dropbox has been growing, as this will tell us whether Dropbox is a good alternative to these big competitors. Then, of course, there's the threat of some new technology coming out that changes how files are stored. See, they are in a fast-moving technology sector, and something newer and better could just come along. That is the risk we take with any tech stock. Now, with most companies that I look at, the founder of the company isn't the CEO at the moment. Generally, the companies that I look at have been around for such a long time that the founder's most likely dead. But in the case of Dropbox, the founder, Drew Houston, is still the CEO and he has a 25% ownership in the company. Now, I think that's actually really important, and it's actually going to play a big part in the investment thesis here for Dropbox. So normally, we have no idea how the management team are going to act. Normally, we just have to hope that they have the best interests of the shareholders at heart, but that's not always the case. But what if the person running the company was also the largest shareholder? Well, in that case, their incentives are definitely in line with me as a shareholder. So after reading the book 100 Baggers by Christopher Mayer, over the past 40 years, a big similarity of the companies that have gone up 100 times, so that's 100x, is that the management team have had big ownership percentages in the company. So I think that insider ownership really does matter when we're looking to get really outsized, gigantic returns in an investment. So in this particular case, Andrew Houston's net worth and financial success is tied to the success of the company Dropbox. So as an investor, if the CEO and myself are on the same team, well, that's a great thing. And he's also around some good company. He's actually on the board of directors over at Facebook. So now looking at the industry, I really like the industry that they're in. I think cloud storage is critical to the success of lots of businesses out there in the world, and it's becoming more and more important for individuals too. Outsourcing storage is very convenient, and I just don't see that changing anytime soon. But like I said earlier in the threat section, they are in a fast-moving technology sector, and something new could come along and disrupt them. So that is the risk we're going to take here in the tech sector, and they also have to deal with all that intense competition. So look, I know this investment isn't for everybody, but maybe it is for you. Now, if we look at the comparison to the big competitors in the space, Dropbox are actually currently number 2 behind Google Drive, but have a big lead on Microsoft. With any business, to check the financial strength of the company, we need to look at these 3 areas. Can they handle their debt? Are they growing? And are they a well-managed company? Now, if you are feeling a little bit inexperienced as I go through this strange terminology in the financial section, look, don't worry about it at all. Just try to follow along, get a feel for what's happening. Look, it's part art, it's part science anyway. It is really important to look over the company's debt because a business can't really go bankrupt if they have no debt. Debt is the number one reason that companies get into trouble. So to see if the business can handle its debt, I go through the debt to equity ratio and the current ratio. So this is the debt to equity graph for Dropbox, and it is very low, and this is great to see in a tech company. I normally want to see this under a 0.7, and it's well under that. Now this graph is the current ratio, and it is lower than 1.5, which I'd prefer to see. But because their long-term debt to equity is low, as long as it's stable and above this 1 number for a current ratio, it is okay. Now in the finances, to check for growth, I look at the book value per share, the earnings per share, the operating cash flow, and their gross margins. Now this is their book value per share, and we've seen solid growth here since 2016, so that's good. Okay, now this is earnings per share, and at the moment, as you can see, it is negative. Normally that would be a red flag. But a shout out here to Andrew Letendre. Now, Andrew over in his analysis of Dropbox actually figured out that it's to do with a weird reporting rules for recent IPO companies. Now, if you want more information on this, go and check out his video, but what we really need to do here is we really need to ignore the earnings per share at the moment and look at what's called the free cash flow as an indicator instead. And when we look at how well the company is managed, we'll get to free cash flow then. Now, this is the cash generated from operating activities and more growth here since 2016, so I'm happy with that. Now, gross margins is something that I've started to focus a lot more on lately. See, a company that can grow their gross margins is doing a lot of things right. And this graph here from Dropbox is exactly what I wanted to see in an investment. Big gross margins and growing gross margins. This is a really good sign. Now, we can't just go have a coffee with the management team over at Dropbox to make sure they're doing the right thing. But fortunately, there are some telltale signs in the financials that give us an indication that they're making some good decisions. So to do this, I check the return on equity, the free cash flow, and their cash on hand. Okay, now first up is the return on equity. And now this is a bit of a mess because of that negative earnings per share. We really can't use this as a fair indicator at the moment for Dropbox because of those weird rules. We really just got to see their free cash flow, which we'll look at now. So here is that all-important free cash flow graph. And as you can see, there's been good growth here since 2018. Look, I'm happy enough with this. And this final graph is the cash that they have in the bank, and it's been growing. That's all we have to see. Great, tick. Now, overall, pretty solid financials here from Dropbox. Now, of course, it would have been nice to have gone prior to 2016 to see more of their history, but what we've seen since then has been very good. Everything is trending in the right direction, and with a very positive industry outlook, I think the trend is going to continue. So even though that competition is really strong, Dropbox is growing, and that's what we wanted to see. I really like that they have very manageable debt and that their gross margins are so high. This will serve them very well. Okay, so now it's all going to come down to the valuation. So to get a copy of the intrinsic value calculator that I'm going to be showing you today, well, it's free and it's in the description. Now, when I say intrinsic value, what I'm talking about is based on the growth of the company and how much money the company is making. Well, intrinsic value is the correct share price today. Now, it's not perfect because we're making assumptions of the growth rates, but it helps us get this ballpark figure. Now, of course, the stock market often overvalues or undervalues a company. So this is just one good approach to working out its value. Okay, so the data inputs that I've used for Dropbox, well, I've started with a growth rate of 17% for the next 5 years. Now that's an average of what the analysts think plus my own opinion. But in this case, some analysts are thinking it could be as high as 35%. So there's a big room here for to change our intrinsic value. I'm going to be conservative and use 17%. And then the growth rate for years 6 to 10, I'm going to say it slows a little bit to be conservative and use 13%. Now I've put in for the discount rate 8.5%. It's just rounded up to 9%. The multiple I could sell for, now this is a tech company and I think the gross margins warrant that this could be, give it a PE of 20 I think that's okay. Now the operating cash flow minus the maintenance capex, I've actually just pulled the free cash flow number because it was easier to find in this case. So that was 407 million, and there's 415 million shares outstanding. Now this doesn't give us a price I want to buy at, even though it says here in the calculator. This is actually what I would call intrinsic value. So this is what I think the share price should be today. Now to find the buy price, what I need is a margin of safety, and I like to have a big margin of safety because we're making a lot of assumptions here. So I'm going to change the discount rate to 20%, and that gives us a very comfortable margin of safety for a tech company, and it tells us the price I want to buy it at is about $18. Now I could change that to say 19%, gives us $19. 18% is what I'd use for, say, Google. That gives us about $20.50. So thinking about all that, just playing around with those numbers, I think a good price is about $20. That gives us a pretty good margin of safety. So please play around with different growth rates yourself. If you think things will be better than what I think and what the analysts think, then put up the growth rates and see what happens. Now please just don't forget that margin of safety because we've made a lot of assumptions and we need some breathing room for errors. Now depending on when you're watching this video, it's currently late October, early November, and the share price is around about $20. So do I want to invest in Dropbox? Well, I think this is a really interesting investment. It checks out across the board for everything that I'm looking for in an investment. So I see the risk here is that they're not going to hit that 17% growth rates over the next 5 years, but at the moment, all signs are pointing to that being likely. And I also think the tech sector is actually a really hard sector to invest in just because technology changes so rapidly, and I just can't see what the future is going to be like in technology 5-10 years away. So in this case, I think the upside is extremely positive and the downside is actually minimal. As Moj Pabrai would say, heads I win, tails I don't lose much. So I think I'm going to invest at $20 and hopefully again at say 17. I hardly ever find companies that could potentially be our 100 bagger. So that's a company that goes up 100 times its value. And I don't think Dropbox is going to be that 100 bagger, but it has everything that I'm looking for in a potential 100 bagger. And those things that make a 100 bagger are that management are heavily invested, they're growing, the future of the industry they're in is really solid, and they have growing gross margins, and enough of a history that I feel that they're not reckless. Now, I'd love to hear your thoughts on this investment because I know a lot of people out there are going to have very different views on Dropbox. Now, for another great analysis, check out Andrew Latundre's video on Dropbox where he analyzes it in more detail, and I think it adds nicely to my video. I'll put the link just here somewhere, and if you haven't done so already, please like my video so I can get some feedback whether this was good or not. Please hit subscribe to my channel so you don't miss out on any future videos, and I will see you next time.
Thank you.